The number hit the Bloomberg terminal like a flashbang, $57.8 billion gone overnight. Canada, once the U.S.'s quiet and reliable financial partner, had just dumped nearly 15% of its Treasury holdings in a single month. Traders didn't blink, they panicked. At the center of it all was Trump's tariff package, a sweeping, unilateral move slapping up to 30% tariffs on Chinese goods and imposing a 10% floor on all imports outside North America. But instead of isolating Beijing, Washington triggered a silent revolt, not from adversaries, but from allies. The most aggressive response didn't come from China. It came from Canada, which had just been hit with renewed steel and timber tariffs weeks earlier. According to U.S. Treasury data released June 18th, Canada's holdings of U.S. debt plunged from $426.2 billion to $368.04 billion in April, dropping it from 5th to 7th place among foreign creditors. This isn't a currency war. It's something quieter, colder, a financial disengagement. China, long accused of weaponizing its Treasury holdings, only reduced its U.S. debt by $8.2 billion, its smallest monthly cut of the year. Yet the significance lies in the consistency. April marked China's second consecutive month of selling, bringing its total to $757.2 billion, the lowest since 2009, according to Treasury International Capital data. Unlike Canada's sharp dive, China's moves are methodical. In April alone, it added 70,000 troy ounces of gold, lifting its official reserves to 2,292 tons, now 6.7% of its $3.22 trillion in foreign reserves, up from just 4% 2 years ago. This pivot isn't merely financial, it's strategic. Irony sharpens here. Despite face value purchases totaling $9.2 billion, Canada's highest since 2023, the mark-to-market losses from April's yield spike wiped out those gains sevenfold. Canada didn't just sell, it lost value on what it kept. As Treasury yields spiked, marking the steepest rise since 2001, bond prices fell, and central banks paid the price. While headlines fixated on China, 6 U.S. allies trimmed in tandem: France, Germany, Switzerland, Norway, Luxembourg, and South Korea. Together, they cut U.S. debt holdings by $14.2 billion in April. This wasn't mass panic, it was reallocation. Eurozone bond yields surged thanks to Europe's fiscal stimulus and a stronger euro, pulling global capital inward. According to Barclays data, central banks now account for 20% of Eurozone syndicated bond purchases, up from just 8% in 2021. France and Germany, through joint EU bond initiatives, have made euro-denominated debt liquid enough to compete head-to-head with U.S. Treasuries. That's new. The contradiction is stark. The U.S. imposed tariffs expecting resistance from China, but its allies who are financially repositioning first. South Korea's National Pension Service shifted billions toward euro and emerging market bonds, citing better long-term parity and yields. Norway's $1.6 trillion sovereign wealth fund followed suit, adjusting bond exposure not with headlines but with portfolio memos. Even Switzerland, long the poster child of U.S. debt stability, reduced Treasury exposure as part of a regulatory-driven rebalance. Not out of fear, but because liquidity elsewhere had improved. Let's freeze this frame. Because if you assume these moves are political, you might be missing the bigger risk. They weren't personal. They were procedural. What if the mass sell-off wasn't protest, but preparation? By May, the signs had compounded. The euro appreciated 12% against the dollar in the first half of 2025, making U.S. debt more expensive for foreign holders in FX-adjusted terms. Meanwhile, euro bond issuance surged, giving global investors alternatives: rising yields, lower perceived political risk. In March, Canada issued a $3.5 billion 5-year global bond, which drew $14 billion in orders, quadruple the demand. The proceeds weren't used domestically. They were earmarked for higher-quality euro and Canadian instruments. That decision came weeks before the Treasury dump. There's a pattern here. Yet paradox emerges again. Canadian pension funds and insurers increased their U.S. Treasury purchases in April. Statistics Canada confirms net inflows despite Ottawa's sell-off. Why? Because the new bonds were attractive, offering the highest real yields in over a decade. Traders are betting short-term pain delivers long-term gain. Canada's government is reducing exposure to macro risk. Its private sector is chasing short-term returns. Much of what's now threatening the dollar's dominance was built with American encouragement. The EU's bond market liquidity, backed by U.S. institutional investors. China's offshore yuan system, developed partly with help from Western banks. Even gold's renaissance, fueled by Fed-driven inflation and, political volatility. The U.S. wrote the playbook, now being used to unwind its own financial leverage. Emerging economies are joining in. India, Brazil, and South Africa, once heavy Treasury buyers, are scaling back, now favoring onshore instruments and multilateral reserves. Brazil's central bank raised its gold holdings to a 50-year high. India's Reserve Bank is boosting rupee-denominated bond liquidity to reduce reliance on U.S. debt markets. It's not a boycott, it's a branching out. Despite the seismic repositioning, total foreign holdings of U.S. Treasuries still stood at around $9.13 trillion in April, just $36.1 billion below the month prior. This is the paradox. The system is unwinding slowly, not suddenly. The exodus is deliberate, surgical, and honestly, pretty quiet. There's no run on the dollar. But there is a steady erosion of its centrality. The White House hasn't acknowledged the Treasury sell-off directly. Instead, Trump has emphasized strong job growth and manufacturing gains under the tariff regime. But analysts at ING and Citi have flagged the April bond data as a signal of growing reserve polarization, where financial institutions are forced to choose between yield and political exposure. The timing of the Canadian cut, coinciding with new lumber tariffs and cross-border energy tensions, suggests economic messaging cloaked in portfolio decisions. Still, attributing direct political motive remains speculative without official confirmation. It's tempting to read this as retaliation. But what the data confirms is structural repositioning. Yield shifts, currency differentials, regulatory rules, and FX hedging costs are now making treasuries less automatic as a reserve pick. Even Japan, the largest U.S. debt holder, increased holdings by $3.7 billion in April. But as a counterpoint, not a trendsetter. The final contradiction may be this. The U.S. Treasury market is so dominant, so liquid, so vast, it gave the world a safe place to sell it. Liquidity, once America's strategic moat, is now the exit ramp. And yet, no single actor can collapse it. Canada's $57.8 billion exit? That's less than 0.7% of total foreign holdings. China's reduction? Barely 0.1%. What's shifting isn't the mountain, it's the weather around it. Canada didn't burn the bridge. It built another route. China didn't sell to shock. It bought gold to insulate. The EU didn't exit. It matured into a co-equal system. The question isn't whether the US dollar will collapse. It's whether the world still needs one reserve anchor at all. But as capital disperses, pressure converges on Washington. Behind the scenes, the Federal Reserve is now walking a thinner line. In April, Treasury yields surged across the curve. The 10-year note briefly touched 4.92%, while the 30-year hit its highest level since 2011, according to the Federal Reserve Bank of St. Louis. This spike raised borrowing costs not just for the government, but for every mortgage, car loan, and corporate bond in the system. In theory, tariffs were meant to shrink trade deficits. In practice, they've inflated the cost of government borrowing. The irony deepens. While Trump champions so-called economic patriotism, the tariff regime is expanding, not shrinking, the budget shortfall. According to the Congressional Budget Office, the U.S. deficit for fiscal year 2025 is projected at $1.9 trillion, up from $1.6 trillion the year before. Interest payments alone could reach $892 billion, making it the fastest-growing category in federal spending. When Canada sold $57.8 billion in treasuries, it didn't just create market noise. It repriced U.S. debt itself, forcing yield higher to attract replacement buyers. But higher yields mean higher costs for the very nation those buyers are exiting. In effect, foreign governments are now setting the price of U.S. fiscal choices. And still, the dollar hasn't collapsed. That fact alone invites complacency. But currencies die slow deaths. They don't scream, they fade. The last time a global reserve system unraveled, it didn't happen all at once. The British pound, once the linchpin of global finance, remained in use for nearly 25 years after World War I, even as the empire that backed it crumbled. Sterling didn't crash, it was managed down. Central banks hedged, shifted, and eventually abandoned. The same signs now shadow the dollar. According to IMF COFR data, The dollar's share of global reserves has fallen from 71% in 1999 to just 58.4% in 2024. The euro holds 20.1%. Gold, once dismissed as a relic, now accounts for 15% of total central bank purchases this year, according to World Gold Council data. One reason: control. Gold isn't subject to sanctions. Euros aren't dictated by Capitol Hill. Even China's renminbi, though less liquid, is now used in BRICS trade settlements, replacing the dollar in transactions with Russia, Brazil, and Iran. According to SWIFT data from May 2025, reserve decisions are no longer just about return. They're about insulation. Yet Washington's playbook hasn't changed. Trump's tariffs have brought the U.S. back to 1980s-style trade brinkmanship, but the financial world no longer runs on Cold War rules. In 2025, capital is mobile, portfolios are programmable, and reserve shifts happen in milliseconds. That agility is what the U.S. may be underestimating. Meanwhile, Europe is pushing toward fiscal unity. What began as a post-COVID recovery tool, the Next Generation EU Fund, has evolved into a permanent fiscal backstop. According to the European Commission, the bloc will issue over 450 billion euros in bonds by 2030, creating a legitimate rival to Treasuries, denominated in a strengthening euro. As the EU matures its bond market, credit agencies like S&P and Fitch now rate EU-backed bonds at AA+, just one notch below U.S. Treasuries. That's close enough for most central banks. Even Japan, long a stabilizing force in the U.S. bond market, is now repatriating capital. With the yen slipping below 160 per dollar, the Bank of Japan has begun selling foreign assets to stabilize its currency. While Japan added $3.7 billion in treasuries in April, it's now under pressure to unwind. So while official numbers show resilience, the underlying flows reveal a more fragile picture. The Reserve Bank of India, for example, now allows central banks to invest in sovereign green bonds denominated in rupees. In June, Abu Dhabi's sovereign wealth fund became the first to diversify its reserve tranche with Indian sovereign paper. The dollar wasn't removed. It was bypassed. What does that mean? It means the reserve system isn't being overthrown. It's being outgrown. This isn't the end of dollar dominance. It's the beginning of dollar irrelevance. For certain transactions, for certain governments, in certain moments, the erosion is conditional, not total. But erosion compounds. And with every yield spike triggered by geopolitical friction, central banks are reminded. Holding U.S. Treasuries now means holding U.S. political risk. That may still be acceptable for allies. But for everyone else, the alternatives have matured. If Canada, once the fifth largest U.S. creditor, can step back without warning, what stops others from doing the same? If China can quietly replace treasuries with gold and euros without consequence, what's the incentive to stop? And if Washington continues raising tariffs without regard for financial repercussions, who pays the price? The data says the U.S. government does. The taxpayer does. And ironically, the Federal Reserve does, through its role as buyer of last resort. When foreign appetite fades, this is the feedback loop now shaping the global bond market. Tariffs raise yields. Higher yields raise deficits. Deficits raise issuance. Issuance demands buyers. But the buyers are leaving. And still, U.S. policymakers behave as if the market has no memory.